Mswatu ingosi thula akayithathe akahambe nayo akayithathe yedenza bakewone akayithathe
Right, your time now is 2 p.m. and you are watching the Monday edition of Market View right here on Eswatini TV. I am Nothlesi Tole, glad to have you on the program. The recently held Tax Indaba brought together government, the ERS and the private sector to discuss issues affecting the country's tax system, including compliance and the growing concern over some businesses failing to meet their tax obligations. Now, we want to understand the real state of tax compliance locally. Are businesses struggling to pay taxes because of a difficult economic environment, or is there really a culture of non-compliance? What were the key issues raised behind closed doors, and what does this mean for revenue and fairness in the tax system? For this conversation, we'll be joined by Business Eswatini's Head of Trade, Musa Masego. But first, business stories. And in our business stories, we begin with this. The Prime Minister, His Excellency Russell Dlamini, has launched the Eswatini Investment Conference 2026 under the theme Explore, Invest, Trade. Speaking at the Royal Villa, Eswatini, His Excellency said the conference, which its date is yet to be announced, is aimed at positioning Eswatini as a premier investment destination.
For investment, innovation and partnership, and ultimately as an accelerator for growth and transformation for our economy. Allow me to take this opportunity to recognize and sincerely appreciate the partnerships that made last year's conference a success, the support that we received from the private sector, including our platinum, diamond and bronze sponsors, as well as the many organizations that purchased tables and actively participated. They all played a crucial role in achieving the outcomes that we celebrated. Your contribution demonstrates the strong commitment of the private sector to the economic future of the Kingdom of Eswatini. We have deliberately positioned this conference as an opportunity creating platform, one that brings His Majesty's government and the private sector to collaborate meaningfully in driving economic transformation. A brief reflection on the projects launched during last year's conference reveals encouraging signs of progress, albeit at varying stages of implementation. Among these are the Ubombo Sugar Limited project, which successfully concluded its agreement with the National Power Utility. The Select Home Residential Accommodation project for the African Alliance Group, the soon-to-be-launched commercial distillery by Rescorp for the production of the Spotted Horse beverage in Eswatini, and several renewable energy projects whose construction commenced earlier this year. These developments reaffirm that the conference is not merely a platform for dialogue, but a platform for action and implementation. The upcoming edition of the conference is expected to be even bigger, both in terms of participation and the tangible impact it will have on our economy.
The Minister for Finance, Honourable Neil Wykenberg, has maintained that despite the national budget deficit exceeding 5 billion malangeni for the 2026-2027 financial year, government remains committed to maintaining fiscal discipline. The minister emphasized that government is determined to keep the debt to gross domestic product GDP ratio below 45% in order to ensure that the country's debt remains sustainable and manageable. He stated that this approach will enable government to effectively manage its financial obligations while continuing to meet its repayment commitments. The minister made these remarks during the post-budget seminar held on Friday while responding to a question from the governor of the Central Bank of Eswatini, Dr. Philip Mnisi, regarding the manageability of the country's debt.
You can take two roads. You can take the road to say, let me keep my debt at low levels, create the confidence in the private sector, put what you can to enable the private sector, and have that be the engine for growth. Or you can say, let the government lead the growth, which means that we say, let government push the debt levels very high, invest in whatever you feel you need, even sometimes infringing in private sector space. We mean government now doing the mining and doing private sector business, and just drive the growth through that approach. My view is to say that let us rather take the first option. But views differ here, even within cabinet and within Eswatini. There's many views say, no, let us rather put down the handbrake on the debt levels, and let us use our balance sheet, leverage that as heavy as possible, so that we can get better growth through the economy by driving and by pushing investments in that space. And yes, as a country, keep in mind, I was in the forest industry before I became Minister of Finance. So I've naturally got a very long, when you plant a tree today and you're going to wait 20 years for the tree to grow before you cut the tree down, you naturally have a very long-term sustainable view on life and on things. And so I absolutely believe in the first approach, is to say, let government because the problem is, when a country gets into default, the private sector suffers. It's the private sector that runs out of forex. The moment a country runs out of foreign reserves and forex to be able to help the nation with, the economic growth takes a tumble. So to be able to protect from that and be able to make sure that doesn't happen, I believe that the first approach is the best here. And so the bottom line is, at the moment, we are saying in the medium term, we've been saying for a long time, we don't want to get above the 45% debt to GDP ratio.
SADCO Chief Executive Officer Kethiwe Mhlanga highlights some of the areas where they feel government should put more effort and financial support to assist the small and medium enterprises.
What is key is capacitating them and ensuring that there is that financial management, business development acumen, and providing not only, we speak of factory shells for the foreign direct investor. We want factory shells for our MSMEs. SADCO is not sustainable for them, for example. They need to move out of SADCO and now have access to factory shells that are for Eswatini.
Moses Yaya, Business Eswatini's Vice President, Industrial Relations, shares what he thinks will ensure economic sustainability.
But for a small, open economy like ours, I think the more important question is whether each budget gradually, each year, reduces the fundamental economic structural constraints that we have in the country that limit growth. And in our case, I think those economic structural constraints, and I refer to them as SEM constraints, which is SACU revenue dependence, energy dependence, and the market size limitations that we have because of our size and our landlocked geography.
Economist Sanele Sibiya shares some of his views about the budget.
Education, highest share of the budget, and that's one of the ways we get our people into long-term sustainable employment, and thereby dealing with the poverty problem. And then health, even though we're below the 15% mark, but I do believe if we can get medication to people would be making a valid impact in people's lives. And then in terms of how we get to fill the budget, with capital expenditures, we expect that there is going to be the direct transfer of money to people's pockets through employment. And we are seeing, the rounding up of multiple factory shells. Again, that's going to be an avenue for employment. And in terms of, where I found it a bit wanting was in terms of what are we doing to target the youth directly. I've always said that for the past three years, because that's where we need to shift things and move gears forward so that we get that huge part of our labor force into work, and thereby we reap what we call the demographic dividend.
The Minister for Finance tabled a 36.92 billion emalangeni budget for the financial year 2026-2027, up from slightly over 32.6 billion emalangeni in the current financial year. Reporting, Nelson Ndlangamandla, visuals by the Central Bank of Eswatini.
And that is your business brief this afternoon. After the break, we speak to Business Eswatini. Stay with us.
To all the viewers of Eswatini TV in the kingdom and beyond. Eswatini TV is regulated by the Eswatini Communications Commission through the Broadcasting Code and Broadcasting Guidelines. Under these instruments, the station commits to broadcasting information and news that have been fact-checked, programs and content in respectful language with no elements of hate speech, violence or sexual activity. If you hear any unsuitable content on this channel, you have a right to voice your complaints with the station management. Should you not be satisfied with the response or action taken, you can escalate your matter to the Communications Commission at PO Box 7811 Babani. Call 2406 7000 or send an email to info@esccom.org.za. For more information, visit www.esccom.org.za.
Welcome back, and moving on with the program, local businesses have raised concerns about the realities of tax compliance. Issues around economic pressures, administrative hurdles, and cash flow were part of the discussions at last week's Tax Indaba. Head of Trade at Business Eswatini, Musa Masego, joins us virtually to unpack what businesses are struggling with, the response of the Business Eswatini, and what needs to be done to support businesses while ensuring tax compliance. Musa, good afternoon. Thank you very much for your time. Let's start here. What were some of the key issues or concerns that were raised by some businesses about tax compliance or the current tax system in the country, whether it's penalties or it's the tax rates? What really caught your eye?
Good afternoon, and thank you for that. So I think, first of all, it's just to understand what the Tax Indaba is. This is a dialogue platform that was created by Business Eswatini, and with the willing, I must say, participation of the ERS to actually come in and engage on topical issues that are affecting the business community during that particular season. With that being said, we really did have two issues that we wanted to discuss this year, or at least this particular time around. The first one being just a few clarifications on a practice note that was published by ERS that deals with taxation of employee benefits. The other issue, which a lot of people have seen on social media, speaks to the new regulations on tax compliance certificate requirements. This really is a hot button topic where quite a number of issues were raised. I must say we did have spirited discussions between ERS and the members of Business Eswatini. Now, in a nutshell, perhaps I can just touch into what are the core issues in principle without getting too much into the technical details. There was a campaign, I think, education campaign that ERS has started to embark on that speaks to these tax compliance certificate requirements. Of particular note was the requirement that all procurement, or at least all tendering for services above 20,000, needs the supplier to provide a tax compliance certificate. Now, the concerns raised here was starting with the administrative burden of dealing with the issues of applying for the tax certificates from what others view as really a low threshold. And there is a feeling that this then does particularly negatively impact your smaller and medium enterprises. Now, it's very important to note here, the issue is not a reluctance to be compliant, but rather the efficiency of the tax administration system. And what I mean by that is you do find certain instances where the company and the tax administrator don't agree on the tax liability. Now, as you're still working to resolve that, the system that is currently in place then doesn't really then produce a tax compliance certificate. So in as much as you may be compliant during that particular time, just because you're still working on resolving the quantum of the tax liability, it then precludes you from acquiring that tax compliance certificate. And therefore, the fear is that a lot of, particularly the smaller companies, would lose those business opportunities. That is the first part. The second one, which I already mentioned, goes to the issue of the administrative burden that is now placed on the companies with regards to ensuring tax compliance. What the business community feels like is, as a taxpayer, my job is just to ensure that I pay taxes on time. It is the role of the tax administrator, in this instance, ERS, to ensure that other companies are compliant with the tax regulations. So, in as much as we try to work with tax compliance companies, in the vetting process, I may request a company to provide me with either their VAT registration, for example, and or a tax compliance certificate. However, it should not then be upon me as the company to ensure continual compliance with the tax regulation throughout the year. This is some of the administrative burdens that a number of the companies feel perhaps it is a bit too much, and let's try and work to find middle ground between complying with the existing regulations, but also not overburdening compliant companies with excessive administrative work, as well as handing over the burden of trying to get the non-tax compliant companies to follow the legislation.
Thank you for that one, Musa. The service, or ERS, has raised concerns about non-compliance and outstanding tax debt, despite having engagement or campaigns that encourage compliance. As you speak with these businesses, these different industries, how big is the problem of businesses failing to pay taxes or comply at all? Because, as you say, it's not really a matter of reluctance.
So the issue then of non-compliance is really twofold. There's what we call voluntary non-compliance, which in layman's terms is basically tax evasion, and then there's involuntary tax compliance, which might be issues of misinterpreting the legislation or just administratively falling behind and due to one reason or the other. Now, it's important for us to make a distinction between the two, because from a business Eswatini perspective, we have been working with ERS in terms of improving voluntary compliance. That means if I note that I made a mistake in filing any of my taxes, there is a route towards sitting down and negotiating with the ERS in terms of how that tax liability is being closed. At the same time, we have seen and we have been shown the data that there is an existing tax gap from basically tax evasion. Now, that issue, we feel, then provides grounds for uncompetitive behavior, particularly through those companies that, for example, may collect VAT but not remit to the tax authorities. Now, for that one, our position is very clear. Those that deliberately collect tax and don't remit should be prosecuted as per the law. What we have been working on in terms of plugging the tax gap as well is just awareness of some of the issues that are faced by the businesses that lead to voluntary or involuntary compliance, as it were. So, like I mentioned, those you find that the issues of just either late filing or, like I mentioned, that there's a misunderstanding with regards to how some of the taxes should be filed. And that is why we have these engagements on a regular basis, so that we can ensure that everyone understands their obligations as a taxpayer, and everyone understands what is the best way to resolve perhaps any questions or areas of clarity that may be needed.
Musa, in the interest of time, we'll leave it here. Thank you very much for talking to us. That was Business Eswatini's Head of Trade, Musa Masego, unpacking some of the deliberations with the business community during last week's Tax Indaba. Moving on with the program, after this, we speak to in-house economist Sanele Sibia. Stay with us.
When you choose your adventures, you do so with an open heart and a desire for the unexpected. You embark on journeys to discover new worlds, full of wonder. You choose a path to awaken your senses, a world to make you look up and realize just how inspiring this life can be. Arrive and awaken your heart. Explore life in ways only thought possible in your dreams. Discover just how far you go to expand your understanding of life's greatest mysteries. There's just one place on this planet with so much to offer. Now is the time for you to have the royal experience.
Welcome back, and thank you for staying with us. Now for our market analysis segment, in-house economist Sanele Sibia joins us virtually. Mr. Sibia, thank you very much for your time. The last you and I spoke, if I recall, crude oil had just topped $85 per barrel, and today we're looking at over $100 per barrel. How is the spike in oil prices affecting global equities, and do you think it could trigger just a new inflation shock?
I thank you, Notsile. A good afternoon to you and also a good afternoon to the viewer. So what we are seeing happening in markets today is really a reaction to the news that we saw coming out of Iran yesterday, where the Iranian government, that panel of experts came out to say they have actually appointed a new supreme leader, there being the son of the late the later supreme leader. So what that sends to markets is this is going to be a protracted war. So the U.S. has definitely sends a signal that the U.S. has failed in its motives around regime change. And now we don't know what the objective is, because now the Iranians have installed a new leader, and it seems they will install another one after this one, another one after this one. Earlier on, markets were thinking like, since they are not going, since they were killing all the leaders, since then it wasn't practical that they should install yet another leader. But now we've seen them doing it now, so that's what markets are just reacting to. It's all carnage across the globe, all red, largely because there are those inflation fears coming back into play in markets. The American stock exchange, the Dow Jones Industrial Average has lost 453 points. The Nasdaq Composite Index lost 361 points, and the S&P 500 lost some 90.69 points there in the US, largely because there isn't a clear direction of what the Trump administration's strategy is going to be, now that we've seen the Iranians installing a leader. We were not expecting this one. We somehow expected that three-panel that was announced last week to continue running the country. But for the Iranians to get to a point where they are saying we are installing a new leader, and this is the new leader that we have, signals that the war is far from over, and that signals that we are most likely going to see that blockade of the Strait of Hormuz, and we are most likely going to see attacks on energy infrastructure. I mean, we've already seen some coming out of Qatar and Bahrain yesterday, where there has been an attack on an energy plant there, and then that also sent shockwaves through Europe, with the FTSE 100 losing some 131 points in today's trade, very close to the 10,000 mark. And if this momentum continues, most likely we'll see all share volumes in terms of the FTSE 100 coming down to that 9,000 mark. But it depends how this war is going to progress. In the DAX, we are down to the 23,000 mark. We know that the DAX average is around that 27,000 mark, but now we're down on that 23,000 mark, losing 387 points in today's trade. The CAC 40 in France, bit below that 7,000 mark, sitting at 7,882, bit below that 8,000 mark, largely because we know that Europe suffered a huge impact of the Russia-Ukraine war, because they got a huge component of their energy from Russia. Now this war seems to be threatening that last threshold that they have, that last lifeline that they have through the Middle East in terms of oil. So the energy markets are sending shortwaves into the European markets. In Japan and in Asia, the impacts there are so marked, with the Nikkei back on the 52,000 mark, largely because the Nikkei, Japan gets about 80% of their oil from the Middle East region. Hong Kong on the 25,000 mark, up down from the 27,000 mark that we are used to, and then Shanghai there sitting at that 4,000 mark, because we are still waiting to see what the Chinese government is going to say in terms of whether they're going to take out their reserves, or they're going to find alternatives. You know that there is still the Russian oil at play here, so I think that's why Shanghai is not yet that much confused. In terms of the Johannesburg Stock Exchange, we are back on that 116,000 mark, largely owing to these movements that we are seeing. So the Johannesburg Stock Exchange is being hampered on two fronts. Number one, this is putting pressure on the price of gold, in the sense that the more we see in terms of inflation fears, coming back into the market, it increases bets for increasing interest rates, and now that makes interest-bearing assets more profitable relative to gold. So I think we are likely going to see another surge in the price of gold if the war could get out of the Middle East. But right now, investors are now starting to speculate around what is going to happen in terms of the price of gold and the interest rates there. There hasn't been
Apologies there for the disturbance. That was in-house economist Sanele Sibia sharing insights on the latest market trends. Sibia, I think you're about to just get to currencies real quick.
So yeah, so in terms of currencies, the currencies, we are back on 1670 against the dollar. You know, we're edging closer to that 17 mark again. Against the euro, we weakened a bit at 19.39 and at 9.45 against the Japanese yen, you know, showing some relative weakness across the board. Thank you, Natalie.
Thank you very much for that one. That was in-house economist Daniela Sibia showing insights on the day's trade. Otherwise, this has been Market View, the Monday edition. From myself and the crew, thank you for your company. Until next time, take care.